Hey guys, welcome back. Jeb Smith, Coldwell Banker, residential real estate broker here in Southern California. And somewhere out there is Josh Lewis with Buywise Mortgage. He's trying to fix his camera. So while we do that, I'm going to sit here and have a conversation with myself for a moment. But no, thank you guys for joining us. Tonight is all about question and answer. We're going to talk about the real estate market a little bit and kind of keep you up to date with what's going on with, the housing market, with interest rates. But more importantly, we're here to answer questions, to address questions that you guys had. I mean, there's been a lot of feedback on, videos that I've done recently where there's good quality questions, and it's hard to go back through each one of those. And it's hard to do a video on each one of those subjects because a lot of them are kind of tied in together. So we wanted to use tonight to address some of those. And right now I seem to be the only one on here, but that isn't going to stop us. So here comes Josh. I'm going to add him in here. There he is.
There we go.
All right. So there's Josh Lewis of Buywise Mortgage. So Josh, I mentioned that, a lot of the topics that we're going to discuss are going to come from question and answers, but we're going to start the discussion tonight by actually going with a question that someone asked earlier today on a video that I did, and that was about student loans. So I know you and Scott have done a lot of talks on student loans in the past about qualifying for loans with student loans. So right now in today's market, how hard is it if I'm someone that has student loans? Is that impacting my ability to qualify, or is there something I can do to not count those payments? Like what are we looking at?
So there's multiple questions there behind the question. The big one that we get is people run into issues. They have a bunch of student loans. They have an IBR payment. So for those of you who don't know, it's an income-based repayment or income-driven repayment. So we see people with $200,000-$300,000 of student loans and a monthly payment of $125, $425, way less than would ever pay off that loan over time. Now, when the problem comes when that person doesn't have the greatest credit, or they need a higher debt-to-income ratio, or some of the flexibilities of an FHA loan. So almost all of the people that are waiting into a transaction, someone approved them for an FHA loan using the IBR payments, which we can never do. So FHA has a hard and fast rule. You're always going to use 1%. So most of our buyers want to use an FHA loan with $150,000 or $250,000 of student loans. That's a $1,500 or $2,500 qualifying payment. Even though FHA will allow you to go to a much higher debt-to-income ratio, most of the time it blows things out of the water. So doesn't mean they have no.
Your mic is having issues here. Are we back to the old mic?
No, it's the new one.
Okay.
I can imagine here we might be having some internet connection issues here at the office. But so what I was saying is it doesn't mean you have no options. It doesn't mean you're stuck and can't move to another loan. It just means that FHA is not going to work for you because we always have to use the 1%. So if you have large student loans and you have an IBR payment, you need to look at either a Fannie Mae or a Freddie Mac option. Fannie Mae wants to use it, but if we can show the IBR payment, which Fed Loan Servicing, Navient, the major servicers are very good about getting you documentation to document. And Freddie Mac, if we can't, let's say, if we can't document, use a 0.5%, which for most people will work unless we get into some bigger student loans there. The reason why this is a big issue right now is every student loan in America is reporting a zero payment on the credit reports because you can all over the forbearance stuff. All student loans are currently in forbearance. No one is accruing interest. No one is required to make payments. So normally, and credit was payment.
That mic is just awful.
Yeah,
you're going in and out big time, my friend. Yeah, I don't know if we try it. Well, if we end the broadcast and start this over, it's going to ruin it. So
yeah, the bigger thing with it, I don't think it's going to change.
Headphones, anything?
It's going to be our internet connection.
Boost Mobile. So I'll go to a question here real quick. So Joe Builder came up and said that this house has been on the market for 12 days with no offers yet. Well, Joe, I wouldn't be concerned with my house being on the market for 12 days. I don't know if that's a serious comment or a serious question, but the reality is, people watch TV, people hear from their friends that my house sold in a weekend or my house sold in a couple of days. And so everybody gets the idea that their house should do exactly the same, that their house should sell within record time. And the reality is that's not reality. The average days on market for at least here in Southern California is somewhere around 40, 45 days, which means that it takes 40 to 45 days for homes to go into escrow, which is a lot longer than, say, 12 days. So, homes in certain price points tend to move faster than other price points, which I'm sure you're aware. But honestly, nothing to be concerned with right now. I mean, it's a very strong market, especially here in Southern California. And in talking to realtors across the nation, I'm hearing the exact same thing. The lower price points, and lower means different things for different areas of the country and different regions. But for here in Southern California, if you're under 800,000, honestly, it's multiple offers and getting bid way above asking price in most cases. I mean, I've gone to show 2 properties over the last 3 days, and both properties were only listed 2 days, and both of them had multiple offers and were put on hold because of the number of offers that they had received. So with that being said, the housing market remains strong, at least here in Southern California. So that's my take on that one. Josh, let's hear it here.
And well, let's see. Is it any better? I went to the headphones, but I'm not sure it's really going to help.
It's not great, but we'll keep on with it, and it is what it is. So if people want to stick around and have conversation, then we'll do it. So people are asking what the rates are today. We've got a couple people asking about 30-year fixed rates, and clearly we both know that this is based on a lot of factors. But I'll let you tee it up and answer that question how you want to answer it.
Absolutely. So prior to last week and the increase in Fannie Freddie rates of the half-point add-on, almost everyone, we were quoting 2.875, 2.99 with little to no cost, almost regardless of their qualification, as long as their credit score is above 700. Right now, most folks are in the 3.125, maybe paying a little bit for that loan. Market had popped up a little bit, so before that additional half-point fee was added, rates themselves had gone up maybe about an 8. So we're up about 0.25% from where we were a few weeks ago. So still in the very low 3s on the 30. 15-year, you're probably looking at that 2.75-ish range. So market's just still trying to adjust to all of the changes. And the big thing people need to remember is lenders that were getting really aggressive on their pricing have got stuck with millions of losses because everyone is reading that charge of a half point starts with Fannie Mae and Freddie Mac on September 1. It actually starts with all loans delivered to Fannie and Freddie September 1. So almost everything that's locked and closing now, closing next month, lender's not going to go back and say, hey, you owe us an extra half point. They're just going to eat it. So really, really big losses from that. So just we're not seeing as aggressive of rate sheets as we were seeing, and rates themselves are a little bit higher, and most people are going to be subject to that half point fee. So rates are still very good, not as excellent as they were 10 days ago.
Got it. Now, I've been reading, obviously, there's a lot of people fighting back against FHFA with regards to the half point fee. And do you think it means, clearly a question you probably don't have the answer to, but do you think that goes away, that half point fee, or do you think it remains and we, continue to see it?
I'm going to defer to one of my mentors, a gentleman who used to run all of lending for Wells Fargo, very connected politically, has had a lot of communications. He says it's 50-50. So that's his best guess. I'm certainly going to defer to that. There is a chance that it gets rolled back, and there's a chance that it doesn't. So we're just in a weird spot. You and I were having these conversations 2 months ago, and I would tell him, listen, rates are definitely going lower. Just got on the phone with a client 20 minutes ago, and she's saying, well, what do you think? Do we lock here? Do we wait a little bit and see what happens? The big wild card is the election where we're at right now. Not because it really matters all that much. It's buy the rumor, sell the fact, and a lot of times markets get ahead of themselves and start worrying about what might happen.
Right.
Regardless of what you think politically, so this isn't a statement about who I think should win or what's better, what's worse. If Trump wins, it's 4 more years of the same. So markets know what to expect for taxing legislation and what the administration's priorities are. What Biden and Harris are promising is higher taxes, more regulation, rolling back to a lot of the stuff, and it would generally be inflationary, be considered inflationary for the markets. So markets could just look as the whole election cycle takes center stage over the next 60 days, just go, hey, we're not really sure. So there's not a lot of bond buying to move rates lower. We could just sort of hover in this range until after the election and then see what happened. Going back to 2016, it was a lot of the same thing. No one really thought Trump could win, but everyone's going, okay, Hillary wins, this happens. If Trump wins, this happens. And we had a nice run between the election and January 1 of interest rates, of the market going, hey, Trump's going to be awesome and everything's going to be better. And then they started spiking. So markets don't usually get it right, but we're going to have probably another 4 to 6 weeks of the market trying to sort it out and guess what happens and what each potential administration would do. That'd be the big thing I look for right now.
No, understood. And that addressed a couple of different questions out there that people had, which I threw up there. Lisa asking about, refinancing now versus rates going up and the 30 and 15-year rates, which I'll tee you up on that in a minute. A question came up, which I'll put here on the screen. This is something you just experienced. So they asked the question of, can I sell after refinancing? And we talked about this not this exactly, but we recently talked about, refinancing after you recently refinance. Can you do it? And the answer is yes, but it ends up, quote unquote, screwing the person that originally helped you out. So I'll let you answer that directly, because you have an experience right now where somebody recently refinanced and now you just found out they sold the house. So
yeah, so I can tell you exactly what happens in that situation. Whether it's FHA, Fannie, Freddie, if that loan sells closes or pays off in the first 180 days, whether you win the lottery and pay it off, whether you sell the house and pay it off, whether you go get a new loan and pay it off, the lender that made that loan is on the hook for basically whatever their compensation was. So we actually had a fairly large loan, not huge for California. It was a $680,000 loan. Borrowers had a unique situation come up about 2-3 months after we closed the loan, talked it through with them, and we decided we would wait and revisit it at the end of the year. And we got a nice surprise this week that they actually sold the house and closed it, and we're going to be looking at about a $14,000 penalty that we're going to repay back to the lender. And it's not the lender's fault, because Fannie, that was an FHA loan. So FHA will charge them in the Ginnie Mae pool. They'll get hit for that, and they're going to pass that bill along to us. So the thing to know is, after the qualified mortgage rules passed in 2010 or whatever it was, almost no loans have prepayment penalties on them. So you're not bound or locked or held into anything. You can do anything you want. You just want a question of, is this absolutely 100% necessary? Did I not know this when I did the refinance? Did I not tell the person that did the loan for me? They're going to be on the hook for it. And it's one of the other differences between a major bank or a bigger mortgage lender and a broker. For me, I'm writing that check. If it had been a loan that B of A or Wells Fargo did, they would just eat it. They can't go back after that originator for the fund. So it's just important to know who you got the loan from. Did you give them the information that you might be selling? Is the selling absolutely necessary? And it may be a situation where you say, hey, we're going to sell, we're going to buy another house. That person gets to do the loan. Sometimes that's the cost of doing business and the relationship with someone. You have a great opportunity that comes up, and we do your new loan, we make that money, and it pays back the early payoff penalty.
No, understood. And the same gentleman just came back and said that, I guess a gentleman, I might be wrong there. The same person came back, sorry, and said VA has no prepayment penalty. And I think what Josh said there, this has nothing to do with prepayment penalty, right? This is clearly a loan with no prepayment penalty. Doesn't matter if it's VA, FHA, conventional, what have you. The lender is the one going back after you for the yield spread. The money made on the loan has nothing to do with the prepay, correct?
Yeah, and think about this. No one really pays for their loans anymore. Everyone always asks, well, how do we get paid? Well, we get paid by the lender. And if I were the lender, if I were a bank, Wells Fargo, okay, how do we get paid? We get paid when we sell that loan and we make money off of it. Very rarely does someone go, hey, let me pay all of the costs out of pocket for the loan. So what that early payoff penalty is the person that bought the loan didn't get 5, 6, 7 years of interest payments to make up for what they paid us for that loan. So they're wanting to be paid back. And the crazy thing is, if you pay off on day 180, we have to pay it back. On day 181, contractually, we're clear. And FHA, VA, conventional, it doesn't matter. And you're 100% correct. But again, I think you missed what I was saying there. Under the qualified mortgage guidelines, it can't be considered a qualified mortgage if it has a prepayment penalty. And for that reason, 99.9% of loans do not have a prepayment penalty. So you can do whatever you want. Sell, refinance 2 days after doing the last one.
No, understood. And so we have another comment here. Katie, I know is in my local market. She just said that she has a friend trying to buy a house with a budget of $750, and the house they wanted had 45 offers, all cash on a couple of them. So that's the market that we're in. And at the same time, we have somebody asking, do you think the housing market will go down in California? I've given my 2 cents on every update that I've done, video wise with regards to the housing market. I don't see, the housing market changing for the foreseeable future. And everybody's like, what's the foreseeable future? I would say for the next 6 months to a year, just because of the supply and demand. It's going to take so long for the inventory. It's going to take, regardless of what's happening, it takes so long to shift that table, if you will, between supply and demand. It would take so many houses to come on the market in such a quick time to throw the imbalance there where it suddenly becomes a buyer's market. And I know you mentioned interest rates earlier, maybe going, unsure what's going to happen between now and the election. I agree, but I don't think rates are really going to go up from now, right? I mean, if they go up, it's an 8th here, it's an 8th there, but we're not talking 0.5%. We're not talking 1%, in my opinion. Again, I'm not the expert on the mortgage side, but I think that would crush the economy, right? I think they have to keep
it's not even that. It's simpler than that. I have a saying: if something can't be true, it won't be true. So I had a question, or someone was talking to me today. Well, what happens, when rates normalize and they go back to 5%? I said, here's the reality. You and I are never going to see 5% mortgage rates again in our lifetime. It just cannot happen. And if you remember the chart that I showed when coronavirus first broke out and we saw this big spread develop, the 10-year treasuries going down and mortgage rates weren't. We had like a 2.2% spread divergence between the two. Normally that's in the 1.3 to 1.5% range. The 10-year treasury right now is at 0.6. So if we normalize at that 1.5% spread, to see a 5% mortgage rate, Treasury would have to go to 3.5%. The United States government owes $30 trillion, or will in the very near future. If we go from 0.65 on the 10-year Treasury to 3.5 on the 10-year Treasury, there is no world in which they can debt service all of that debt. So if something can't be true, it won't be true. We're not ever going to see 5% anytime soon. I would be stunned if we had anything in the low 4s. So worrying about higher interest rates, it just cannot be. So it won't. So is the new normal 3.5, or is it 2 3/4? That's what we're going to find out in the next year or two. What I will say and add, you and I have addressed this question before. Everyone always wants to know, and it's a moving target. Is the market going to go down? Okay. We are really witnessing a couple of different economies. People above a certain level, which most homeowners fall into, have been largely protected. Incomes are good, back on the job, not seeing a real loss in income, taking advantage of low interest rates, and everything's great. On the lower end, most renters, most younger people who don't earn a lot of money, $20 an hour or less, has been disproportionately hit by unemployment. Those people are suffering. So when I say, like for us in Southern California, I look at a market where an entry-level home is $750,000 or $1 million, like for the most part it is here in Huntington Beach. People that can buy that, they're not suffering. They're not having a hard time in this economy. Maybe it's not as great as it could have been, but it's not terrible. Now, look at some of the areas that we have here in Southern California: Lancaster, Victorville, the areas where people will go way out to get new homes, lower prices. Those people don't make as much money. They're not as protected. They're not. So you could see some of those areas see higher defaults, but even in those areas, most people have built up a chunk of equity. We will never see a return to what we saw in 2008. We absolutely could see an increase in supply because of forced sales, but you're not going to see short sales and foreclosures for the most part. And we definitely won't see it for 12 to 24 months, even in areas like that.
No, agreed. I mean, again, that's probably the most common comment on any of the videos that I do and conversations that I have is, what about the foreclosures coming? What about this big wave of all of these people that are on, forbearance, what happens when they hit the market? The reality is that that's a year out, best case, right? From the time that the forbearance ends, it's a year out. At which point, if those people are in a position where they can't pay, they can still sell their homes, right? Because most of them have equity positions. They're in a position to sell. Well, let's say they don't, and they decide that they're going to stay in there and not make any payments. We saw what happened in 2008, 2007. It takes years to go through that. I mean, yes, it takes 90 days for a notice of default and whatever, but the reality is, if it hits anywhere like people are thinking, on my videos and commenting that it's going to hit, you know how many cases and foreclosures that would be, and how that would have to filter through the market, and the reality is it's not going to happen, in my opinion, anything like that. But even if it did happen, we're 3-4 years out on that, in my opinion. But that's a whole nother conversation in itself. I mean, we could go down a rabbit hole on that. So we've got a couple other comments here. Lisa again asking about buying a house next year, and I will have a house maker.
So how it affects the debt to income ratio is pretty simple. So when you don't have a history of renting a property out, they will give you 75% of the market rent to offset the payment. And the reason for that is they're going to want a vacancy, maintenance, upkeep factor, and they just use a conservative number of saying that'll cost 25%. So using a super simple example, if your house payment was $1,000 and you could rent it for $2,000, they're going to give you 75% of the $2,000, about $1,500, and that would exceed your payment by $500. So they would add $500 to your income for qualifying purposes of the DTI. Now let's go the other way and say the payment was $2,000 and we run it for $2,000. You're only getting $1,500 credit. It's a $500 negative. That $500 negative is treated like a debt, just like you had a $500 car payment. So it really just comes down to how much you owe, what the payment looks like. So if you have a low amount you have on there, you may not want to refinance right now. You may not need to refinance. Let's say you took out a 30-year at 3.5, 6, 7 years ago, and you're that far into it. Just stretching it back out to 30 now at a similar to slightly lower rate, even though there's not a huge motivation to do it, can lower that payment and make those numbers work out better for you. So something you definitely want to plan for now.
Yeah, I got it. Quick question. So you mentioned the 75% rule, but what if I have that rental on my tax returns and I've documented the rent as it is on there with the write-offs and whatever? Am I getting the actual rent that's on my tax returns, or am I still getting 75% based off a rental agreement?
No, we have to analyze the actual tax return for the last year or two, depending on what the automated findings come up with. And for the most part, people are far more aggressive on their tax return than the 25%. So it usually is worse for someone than if you could choose to use the 75% of the actual rents.
Got it. So if I would, and so if I'm newly, again, we're going to attack this question from all angles. Say I'm newly renting a property. It just became a rental, and now I'm trying to qualify, and it hasn't been on my tax returns. Are we taking my word at that that's the rent, or do I need to document that to qualify?
Either need to provide a lease or just a market rent survey. So the big thing is it has to be reasonable. If you have a little tiny condo and you're saying it's bringing in $8,000 a month so you can qualify for the new loan, it's not going to fly. We actually need some corroborating evidence of what that number is. Because even a lease, the lender says, hey, give us a lease. Well, your brother or your uncle can write and say, hey, I'm paying $8,000 a month for your tiny condo. It has to be reasonable. So if it looks out of whack, there's a number of online sources that we can use for looking up rents.
Got it. So I don't know what happened to our volume there, but it all automatically went down. So we'll try that one more time. But there's one other question that's on here that we haven't addressed. And again, I teed you up for it earlier. I don't think we addressed it, which was interest rates. Where are interest rates today? Now you can answer that however you want, but there's a question about a 15-year and there's a question about a 30-year.
For the majority of borrowers, you're just over 3%, 3 1/8 on a 30-year fixed, unless you want to pay some points. We still absolutely can get you into the high 2s without paying a ton of money. And on the 15-year, you're about 2.75, similar number. And again, if you want to go lower, we can do it. You did the video on UWM offering 1.99 on a 30-year fixed. It's still on the rate sheet. It's still going to cost you 3.5 points to get it. But That's the biggest thing. Like we were talking about this earlier. Scott, my partner, and I are that really the lender doesn't care what your interest rate is. They want a yield. They're going to get that yield either by you paying the interest rate or you paying the interest rate and a combination of points. So really, people wonder what is the interest rate. We have a wide range of rates available on any given day, and it just comes down to what you want to pay, not what you want to pay, what you want to pay. So depending on where you're at. Do you want a no-cost loan? Do you want to pay your own costs, which are pretty minimal, and not pay any points, or do you want to pay a couple points and buy it down? The most important thing, no matter what you think you want to do, is to get someone to help you run through an analysis of those numbers and show you what it looks like now at closing and over time, and how long you need to be in that property.
Got it. So no, exactly. I mean, I think we've addressed that on multiple videos, but it's good to confirm it again. We have another one coming up here. So another person in Southern California basically saying that they've been placing offers even 25 grand above the asking price. They only have 5% down. Should they be waiting till they have at least 10% down? At the end of the day, in my opinion, as a listing agent reviewing offers, it's not going to change my opinion of an offer between the 5 and 10% down. So I don't know that is going to change anything. The reality is that I have to believe that you're probably under that $800,000 price point to in the offer that you're making. And unfortunately, it's just a tough market right now. I mean, I'm a professional in the business. I've been doing this for 18 years. I know how to structure offers to get them accepted, and I'm having trouble getting them accepted just because there are so many offers. There's a lot of buyers going directly to listing agents at this point just because they feel like they have a better opportunity to get their offer accepted when dealing with the listing agent. And so, back in the past, we would write buyer offer letters. We would show a nice picture of the family. I might even do a video and send it to the agent telling them, about our offer or trying to set ourselves apart. And it's tough. It's the reality is, I'm going to be putting a video out tomorrow, the next day, about, things that you should do in this market. And one of them is you have to be patient, and patient in the fact that you're going to be up against multiple offers, and chances are you're going to have to do this multiple times. It's if you get your offer accepted the first time, congratulations, because most people aren't experiencing that. You're up against cash offers in a lot of cases. Some cases, unfortunately, you're up against a buyer that might know the listing agent, or a buyer that might know the seller, or a realtor who might have a relationship with the seller. So there's a lot of factors playing in other than just your down payment and what you're offering. And so so I don't think, to answer your question, 10% is going to change anything. I think you just got to sit back and play the game, so to speak. And when the right property presents itself, it'll all work out. I mean,
And Jeb, I don't know what your thoughts are, but I think the fall is going to be very interesting, because what we're seeing right now is there was 60 days, maybe a little bit more, a little bit less, when people just weren't out looking at homes and writing offers. And now all of those people, they didn't disappear. They didn't decide, I don't want to buy a home. They just couldn't go out and get and see properties. Now rates are even lower, so they're all squeezed into this little window with the same number of homes, maybe a few more homes on the market. It'll be interesting. In Southern California, we generally have a little bit of seasonality where once the kids go back to school, that things kind of slow down. But think about it this year. Kids going back to school, not in the way that they have in the past. So for a number of reasons, the fall season is going to be very interesting for all of us, buyers, agents, lenders. It'll be very interesting to see what happens.
Yeah. I mean, a lot of the mentors that I follow have basically said that, the summer became the spring, and our fall, so to speak, is more or less going to become the summer. So you're not going to see that seasonal slowdown that you see in the fall, because that has now become the summer, because we lost those months in the spring. Everything has just kind of shifted 3 months. And so again, no one knows the future, but I don't see things changing in the interim. That there's nothing major, in my opinion. The election could do it, could change things, but again, that's not an overnight change. You're not going to see, the day after the election, the world changes. That's not how it works, right? I mean, it's worst case, it starts in January and with new policies and even after that, right? New policies don't happen in January. It takes a while to implement those, but even that takes a while to trickle down. So, you're dealing simply with a supply and demand issue, regardless of how you feel or think or whatever, employment is doing or forbearances are doing. Yes, those have an impact, but not to the extent that it's going to crash the market. So that's my 2 cents on that. I could go really deep on that, but I don't want to, bore you guys. So a lot of people here, thanks for asking the questions. Last question we'll address here, and then we'll cut this one today. We're at 30 minutes now. Somebody asked, how low did the 30 and the 15-year rate go? You can answer that, and then you can also answer, how can I get seller to? Well, I'll ask the closing cost question. So 15-year, 30-year, what was the lowest you saw without paying points?
Without paying points, for the best qualified borrowers, probably got to about 2.875, maybe 2.75 for a day or so. And the 15 years, 2.5-ish. So probably 2.5, 2.875 is a safe number that we could have done. 0 points, maybe an eighth lower.
Got it. No. And again, I see people commenting on videos all the time that I do that they got a 2.2 with no cost. One guy said he got a 1.99 with no points and no fees, and God bless him if that's the case. So anyway, last question we'll answer here is, how can you get the seller to pay for the closing costs? That's a conversation to have with your your real estate professional, your realtor, but traditionally you build it into your offer, right? You can do a number of ways. You can add it above and beyond the purchase price. So if the property is selling for $300,000 and you make an offer for $300,000 and you want $5,000 back in closing costs, you can make the offer at $305 and request that $5,000 back. Or, you can make an offer for less than that and still ask for that money back. The thing that you're dealing with right now is, depending on the market you're in Southern California, that's going to be a tough sell. And some of the other markets maybe that aren't as crazy, you might be able to get seller to pay closing costs. Right now, because you're up against other offers, I haven't had the offers lately where I've requested that. But traditionally, it's not a big deal to ask for those. But in a market where you're competing against other offers and trying to make them look as clean as possible, that's probably something you want to try to avoid if at all possible. So, and with VA, there are certain costs that they have to pay, but that's a whole nother video. So, we'll cut it there. It's at 32 minutes. Josh, any parting words? I'll let you throw your information up there. I know a lot of people have questions about interest rates and refinancing. And so, let me figure out how to get rid of this one. You got rid of it there.
I did it for you. Yeah, the last thing I would add to that last question is, probably better and easier to look at getting lender credits to cover your closing costs. An interest rate, you and I both believe that rates are going to stay low for an extended period of time. So if you can handle it in your debt to income ratio, take a higher interest rate, get the lender to credit some of those costs, because you can refinance out of that. When you ask a seller, let's say I need $10,000 on a $500,000 purchase, the seller doing that is going to want $510,000. It's never going away until you pay it off. You do the same $500,000. If we can get a 2-point lender credit, you might end up paying 3/4 point higher in interest rate, but you can refinance out of that at some point in the future. You're not able to do that with the premium pricing on making a higher offer. So it's something that, I don't think a lot of people understand. This is what you and I do. When we're working with a client and we have these constraints, we strategize, what are all of the ways that we can cover this? How do we get them in? How do we make it work? So it's just important that your lender and your real estate professional are on the same team. We again have the biggest lender in the country who wants to throw ads out there, push button, get mortgage, and really it's push button, get connected to the call center. The kid in the call center has no idea how to strategize with your realtor about how to get offers accepted and follow up. One of the things we do, you write an offer, you copy me on it, we're going to follow with a phone call. A lot of the listing agents are so inundated they won't take our phone calls, but we try. We try to follow up with an email, give them a bomb video. Just really stressing how well qualified our borrowers are and how far we are into the process. So a lot to it.
No, absolutely. And again, deal with professionals, whether it's in the real estate mortgage side, you'll have a much better experience. And I think those are good parting words. And guys, if you're new to us, hit that subscribe button. If you want to stay connected, hit that like button to show us you like the video, the content. We'll continue to do these. again, with live, you see we have audio issues. We've had video issues in the past. We'll try to clear that up for everything going forward. But we do appreciate you guys watching, tuning in.
Absolutely.
All right. See you next time.
Have a good one.